Hello and welcome. My name is Thorsten. I'm the founder of Dividend Stocks Cash, stock screener to make long-term profit growth visible. This helps you to buy companies or invest in companies with growing dividends and capital gains as well. In this video, we take a look about a new feature, Dividend Stocks Cash, and it makes share repurchases transparent. So far, we already saw the balance sheet item treasury stocks, but shares can either be retired or added to the position treasury stocks. And if they are retired, we can't see if share repurchases happened. And why is it important? It's important because share repurchases and dividends, they are both useful instruments, but they can both be abused by management. Management, like politicians, want to look good as long as they have the steering wheel. And in times of a lot of cash, we are living in times of a lot of cash, at least for many companies. It's often possible to abuse share repurchases just to look good, to boost the per share matrix. I will show you how this looks like for Starbucks first, and then we take a look at another company everybody knows, where also, in my point of view, an abuse of share repurchases is happening. So let's go. So Starbucks first, if you haven't seen the last video, then you might be interested. There I'm going to detail a little bit more. And we see the new feature in the full chart analysis. And here we are. So Starbucks retires its share repurchases, so you have no treasury stocks here. And here is the new chart, and in this chart we see some interesting things about share repurchases. First, let's zoom in here. And here we see the amount of share repurchase. It's basically the reduction of outstanding shares. So shares from 2017 to 2018 were reduced by 4.6%. It's already a lot. And if you see here the last 6 months, we have a repurchase ratio of 10.6%. That's an estimate for the total year, or it's a forecast for the total year, because this is only half year. So for the half year, 6 months, it's 10.3%. And for the full year, if it continues like this, then it would be 20.6%. So we see an upward trend here, and the repurchase ratio is on all-time high. And that's the new information you hadn't here in this chart. Another interesting thing is we have the earnings per share. It's basically the same as here. You have the same values here. Earnings per share last business year, $3.17, and here we have $3.17 as well. So nothing new so far, but now we have the adjusted earnings adjusted by repurchases. So this is the scenario, what if scenario, if Starbucks hadn't made repurchases. And then we see for the last 12 trading months or the last quarterly data available that we had an earnings per share of $2.31, but and without repurchases it would have been $2.07 only, so 24 cents less. And this information is very nice to get a good idea about the adjustments done by the repurchase of stock. So you know now better if the per share matrix, at least regarding earnings, changed because of organic growth on the company level or because of share repurchases, which could be seen as kind of financial engineering. And now we look at the second stock I promised you, and this is Oracle. And Oracle also does share repurchases. And if you look here at the long-term profit growth, operating cash flow, and reported earnings, it looks not bad at all. We have an upward trend. We have here a slight decline, but upward trend continues. But on the other hand, if we look at the company level, we see that revenues are flat since about 2012 to 2012. And that margins are even slightly decreasing. So there's these metrics are a little bit contradictory. This looks better than this one, and the explanation is, of course, share repurchases. Same like Starbucks, we have no treasury stocks here, which means that the stocks are retired. If we look at the period of interest starting from 2012, we see that we have a constant share repurchases, about 5%, 2013, 2014. Then it declined, even became slightly negative. But then in the last 9 months, we have a repurchase ratio of nearly 20%, similar to Starbucks. And this made the earnings per share increase. If we look at the earnings per share like this, we have a slight increase from last business year 2018 to the last 12 trading months, from $2.71 to $2.76. So we have an increase of 5 US cents. But if we add the adjusted earnings, then we see that in fact without share repurchases we would have a significant decrease from 271 US dollar last business year to $2.36. So that's a change, or that's a considerable drop, and it's 40 US cents less than the reported earnings. And if you just look at this, you can't see it, and you get maybe a wrong idea about the perspective or about the operating performance of Oracle. I would not recommend Oracle as a buy, in my point of view, because of this, and also because, for example, high goodwill in the balance sheet, and especially because of flat revenues and slightly declining operating margins. It's a software company, and for example, if you look at SAP, then you see that there are much better companies in this area. So I just wanted to give you an idea about this new feature. I think it's very useful. We have a new tab here, dividends and capital gains. We have a new tab here, dividends and capital gains. Here you can see the performance of the stock from for each year regarding dividends and capital gains. Okay, that's Thorsten from Dividend Stocks Cash. Thanks for watching. Bye bye.